Good afternoon. Peter Klein, Chief Investment Officer, co-founder ALINE Wealth, with you on the 28th of January. Welcome to the markets. And it's been an interesting month, to say the least. And I'd like to debunk a number of these issues with you and to go and provide you with our thinking as it relates to markets and market conditions. So allow me to share my screen and we will begin. And here we go. Okay, so as you see, the markets here's our take on the markets. And from all intents and purposes, it is sentiment has gone extreme. Risks are elevated. I mean, it's almost crazy town. I mean, to put it frankly, it's almost crazy town. You've seen, I don't have to go through the individual circumstances of the markets in the last couple of weeks and even in the last week, but suffice it to say, we believe that when the music stops, and folks, it will guarantee the music will stop. When it stops, I believe there's going to be plenty of pain to be had. So for us, as fiduciaries, as stewards of our clients' capital, their dreams, their retirements, the education for their kids, their legacies, their charitable portfolios, we're not in the business of taking undue risks. We're in the business of compounding assets over time in a risk metric, within a risk tolerance. And right now, we are reducing our risk tolerance because things have gotten haywire. So let's move forward. Current conditions. Here is an interesting graph that speaks to the concern or the disconnect between stock prices in the blue line and earnings in the black line. Forward earnings. This is years forward, all right? So future earnings, not current or trailing earnings, future expectation of earnings. Now notice how correlated these lines are typically. Here it got a little bit, earnings were ahead of stock prices here, but never before have we seen this type of disconnect. And that's the concern. Things have gotten disconnected and disjointed, and that's where we have some concern. Here is the Schiller index known as the CAPE, cyclically adjusted PE ratios. So you know what a PE ratio is. It's the multiple to earnings that we're paying for when we buy a stock, a security. And the CAPE does, and this is a Nobel Prize winning research from Professor Schiller from Yale, what he's done and has gone back 150, 200 years of data and cyclically adjusted those earnings. So essentially he uses a 10-year moving average, if you will, of those earnings. So to smooth out the peaks and valleys, the booms and busts, to give a more, a smoother metric to which to look at. And this is the index going back to, I guess, the turn of the century, back in the 1800s and into the 1900s. And you could see here how the CAPE index has performed. And you'll see here's the dot-com bubble, and here's where we are today, clearly elevated from the historical average. Even if you look at a post-World War II average, it's still elevated, right? Now, there's been some recent discussions about turning the CAPE on its reciprocal, right? Getting a yield. And what they then do is compare that to the 10-year treasury and to say, the yield you're getting from a 30 CAPE is closer to a 2.5% return. And it's a heck of a lot better than the 1% you're getting on 10-year. So therefore stocks are cheap. Here's the issue I have with that. Negative interest rates. Zero interest rates. These are not normal circumstances. So you can't compare the treasury and the interest rates that are being artificially held low to the equity markets. So this whole notion of comparing the premium to the 10-year treasury, I think is ridiculous because the 10-year treasury is not real. It's not real at 1%. It's not real at negative $17 trillion around the world. Do you know you cannot invest in Germany, in many countries, Japan, many countries around the world, developed countries, and get a positive return on their bonds? They're all negative. So So this is an unusual circumstance. And when something's unusual like that, it's hard to then use it as a means to sort of, compare something and to use it as a metric. So that's sort of my soapbox speech on the risk premium compared to that of the 10-year treasury. Okay, let's proceed. Okay, so sticking with the capes, as you could see here, this particular, I want to focus on this graph here. So this is the current cape, right? And what it's comparing is the years that had lower capes and the years that had higher capes, 99, 2000, 2007. Oh, that's interesting. What do those 3 years have in common? Yeah, I thought you'd figure that one out. This is the 10-year return on the S&P after this particular cape, right? So essentially, when the cape was higher than it is today, all three instances, the future returns were negative. Okay? That's critical because I've always said it, I've always maintained that this, and it's been proven in study after study, that the number one determinant, the factor that's most important in determining the future returns, not the short term. We know that's noise. If anything, in the last week, we know it's noise, evidence in the last week, right? But if you're looking at it from a cycle, a 5, 7, 10-year cycle, the best determinant of those returns is what you're paying today. And right now, evidence of that is we're paying high, and therefore the prospective returns will be low, in this case, negative. That's critical. Here's the price to sales ratio. You know, we've spoken about this, a very mean reverting valuation metric. And by no way or means am I suggesting that valuation statistics are a timing tool. It is not. It is a tool that we use to determine the amount of risk we're willing to take in today's markets. And right now, we believe those risks are elevated. Evidenced here in the price to sales multiple by decile. As you can see, I mean, it's just, what can I say? I'm speechless. It's what it is. I mean, look at these metrics. I mean, no way, even in the least expensive, we're talking elevated. Not to mention here, the top, let's call it the top half, way elevated. And of course, the most expensive, super elevated. This is from our friends at Horizon Kinetics, big fans of them. Here's the market value to GDP, Buffett's favorite indicator, right? Think of it as a very big macro PE multiple, right? Take all the stocks and all the their market caps, roll it up to a big aggregate, right? That's the amount of all the market caps in the U.S. and you compare that to the GDP, right? So it's price to PE, price to earnings ratio, or GDP being the earnings in this case. And as you can see, we are elevated, highest ever. That's going to be a theme, guys. A lot of these things are the highest ever, right? And that in itself is not a negative. But when you don't have the quantitative evidence to support it, you're flying blind. That's the issue. And we don't do that for our clients who entrust us with their capital. So here we're seeing it, way above standard deviation, way above the averages. And the folks at Kinetics, Horizon Kinetics, say here very interestingly, if the GDP continues to grow at 4% a year, okay, for the next 10 years, and the stock market does nothing for 10 years, this metric is still going to be way above what it'll be 53% overvalued over the 40-year average. So, I mean, it's like we are in, a whole new order, or are we? Or maybe things have just gotten out of whack. Here's the long-term this is the that big PE ratio, right? The market cap to GDP over time. And you could see that, where it had been during the 20s and from 1920 to 1980, and then you start seeing it creep up. Again, we had some bullish, markets in this period, and then the .com just took it to a new level altogether. So I mean, we are exposed to a new world here, and the concern is, does it make sense, or is it just a matter of a mania? And and frankly, I'm siding on the latter. That it's a bit of a mania, and we saw that in the last couple of weeks. And how about this? I mean, here you have a situation where you have non-profitable technology companies that are not making money. Let that sit in. Let that stick. Companies that are not making money. And look how well they've done. The junkiest companies have performed the best. So what's a fundamental analyst to do? Are we to throw out all of our years of study, all of the decades and decades of analysis, all of the work that people have done for generation upon generation in this business to study analysis and study fundamental, a business? Is that all gone and now it's all about momentum? I think not. Zombie companies that have no way of making their own payments on their debt, right? So they're basically just sort of, that's why they call zombies. They're just living on themselves and just sort of burning cash just to sort of stay alive until they're not. And you can see the amount of them, 15% of them right now. So very worrisome. And the number of companies that are not earning money, right? Again, much above the long-term average, double, if not more, than the long-term average. We've spoken about debt ad nauseum. I know that, it's probably something you think of me, you think of debt, right? So, I mean, yes, it's a concern. Valuations and debt are two of my top 5 concerns. Sentiment has been moving up, by the way, on that list. This whole gamification or casinoification of the markets. But here's margin debt. Very worrisome, because here, this is investors who are taking more and more risk with their portfolio. Understand how margin debt works. I know it's inexpensive in many cases to utilize. I get that. However, there's another side to it. The other side is, if the assets that are collateralizing that margin debt, ergo your portfolio, if those assets were to come in, fall, correct, what have you, you could have a margin call. And that means that you have to then sell those very same assets, unless you have other capital to put in, which very few people do at that point. Sell those assets to then pay down the margin. And of course, you'll be selling at the lows because the things are down. You don't want to do that. So clearly, margin can be a very toxic instrument to be utilizing in a portfolio, especially to a magnitude that many do use it. And you can see here the amount of debt that's through the roof. And that's a telltale sign that we're getting toppy. Here again, global debt levels around the world, and you can see how they have increased dramatically. And debt to GDP ratios are almost in excess of where they were right after World War II. And where we are. $82 trillion of total debt. About 30 trillion of that is U.S. federal debt. Just way too much. Yeah, easy to handle at these low rates, but notice how the interest rates are creeping higher. The 10-year bond is now 1.05 or so. So we're seeing that now beginning to take hold. And if there were to be an inflation scare, what would happen to the interest rates? They increase. Then where are we? Let's be careful of that. Let's watch those interest rates very carefully. Because again, macroeconomically, we're seeing some softness short term. The last 3 months, the retail sales has been cooling down, as you'll see. This is the GDP, or gross domestic product, as you can see, came in today. We had a release of that news, and it was a little off of expectations. Market still rallied, but that's another story. This is retail sales that have fallen 3 months in a row. This is, how about labor? How about payrolls? I mean, not looking too good, and the idea that, we have a 9-10% unemployment rate, it really, it does weigh on a lot of folks. And, even at 7 or 8%, but we used to have 3%. So you could see where we're at this current juncture. And it's obviously due to the pandemic. I understand that, But are these jobs going to come back like that? I don't know. Are some of them permanently lost? Of course. The number of people that have been unemployed for 27 weeks is through the roof. So that's a worrisome sign because those folks should be, getting back into the workforce, and they're not, which is worrisome. So let's talk about manias. Let's talk about retail investors. Let's talk about what's been going on in the markets in the last couple of weeks in this sort of, I'll call it, gamification. Others have called it gamification. I like to call it casinofication, with the eradication of commissions and the simplicity that people could sit on their couch and use their phone to trade stocks. I mean, I grew up in a time where there was, a science to investing. You researched it. You looked at companies. You just don't play around with like a video game. And yet this is what we're seeing. I think that's a dangerous sign. This is a slide that speaks about how option trading, which is a risky strategy, and many of the smaller investors are using it. They call them retail investors, right? Because they allow a lot more leverage, right? You're able to buy something at pennies on the dollar that gives you a huge upside if it works. And so many of small investors have been using that, and frankly, some of those investors shouldn't even be allowed to trade options given the requirements that are involved there. You need to be experienced, but that's another story. The point is that those option trades affect stocks, because the specialists in those options, those market makers, have to then off put that risk by buying or selling the individual security. And it's that action, it's that buying and selling action that causes the wild swings that we've been seeing in a lot of equities in the last few weeks. So bottom line is, where's a fiduciary, someone who's conservative, long-term capital oriented? What am I to do? What are we to do here at ALINE Wealth and managing your portfolios and keeping you on that course, that winding road of life, and making sure that you don't fall off the guardrails, as twists and turns occur? How do we do it? We look where others are not looking, right? The first thing we want to do is look for uncorrelated assets. They're really hard to find these days. Everything is correlated because interest rates are so low. But we are looking for those that are uncorrelated so we can provide that important level of diversification. Because you're not getting it from bonds, folks. Bonds are a one-way ticket to negative. So, I mean, if you're not getting it from bonds, and everything else is pretty correlated, we have to then do some heavy lifting on the searching side to find investment in funds and managers that have uncorrelated track records, right? Active management. Okay, so we run a core satellite portfolio where the core is passive and the satellite is active. We've been running those portfolios for years. We're reducing our exposure to passive, increasing our exposure to active. Why? Because we believe that passive strategies are too concentrated on a handful of overvalued stocks, momentum based. And so we are seeking those tactical solutions, those actively managed opportunities to outperform and to keep within balance for our clients. There are a number of areas that we are favoring. You'll see in a moment. But the bottom line is that being a contrarian often will lead us to winning in the long term. Going against the herd has always been the way to go. Longer term, not short term. Here are some themes for your consideration. As you could see here, we have several themes that we're working on. We have portfolios and white papers and videos that back these up, from real assets and commodities to gold to the water sector, pipes, pumps, valves, the utilities behind this water sector. There's a lot of compelling economics behind water these days, and there are companies that are in that field are exciting and opportunistic, we believe. Infrastructure being an important part of that. The intersection of healthcare and technology, that's going to be a game changer. We did a video on that just a few weeks ago. AI and IoT, Internet of Things, and sensors, and ESG, sustainable investing. Please listen for our upcoming interview with TerraCycle, and Ethic on sustainable investing. Real interesting stuff. And also emerging markets. We believe that there's an opportunity more so in the international and emerging markets. If you look at the year-to-year sort of who won, what's the best asset class, that chart. Well, if you look at it, it's been like all U.S. for the last few years, since '08, in fact. And so the international markets, which is usually, a couple of years U.S., couple of years international, that kind of thing. It's been international markets have been in the bottom half for more than a decade. We believe that's changing. We believe the valuations are so compelling there and so elevated here that we believe an opportunity is upon us, especially in the emerging markets where you're seeing better demographics, better financials, right? Better growth, frankly, and less debt. So we believe the emerging markets have a lot of opportunity going forward. Dividends, we love dividends. So there's some, 5G on the communication side. So please, if you have some interest in any of those white papers or videos or even the portfolios themselves, contact us at ALINE@alinewealth.com, and we'll be happy to discuss them with you. So a peek into our thinking on the buy side. I mentioned the emerging markets. You could see the opportunity here. Whenever you see, alligator jaws that are open this wide, they're going to close. So the blue's going to go up and the white's going to go down, and you're going to see opportunity to be had. And so be cognizant of this. Here you see the emerging markets beginning to get a bid. We think that we're seeing future year upon year of opportunity in the emerging markets. Value is deeply discounted. I mean, this is historic levels for value. It's picked up a bit in the last couple of weeks, months, but still got a long way to go. And in fact, you see it here as well. In fact, when it does begin to take hold, like it did after the 2000 dot-com bust, value took off, right? After 2008, for a couple of years, value took off. So when it does take hold, there's usually a substantial multi-year outperformance. So you want to be in there for that. And here you see short, small cap value being one of the least desirable, or the funds that have the least, I think, the best opportunity going forward, but have done the poorest. The case for real assets is compelling too. So we believe in inflation is likely to be the next big thing. And so we see here M2 is jumping, and when M2 jumps, inflation follows. So if inflation were to follow, commodities is likely to do the same, and commodities have been in a awful bear market for 15 years, so they're due or overdue. And here back to water, as a commodity, as a real asset. I'm showing here the amount of water or the snowpack in the Colorado Basin and how low it is comparatively to previous years, right there. And so we worry about that. And as the scarcity of water it becomes more prevalent, we're going to see obviously more work being done on pricing it potentially, as well as there's more value to those water rights in certain parts of the country, and those companies that are making it so that the water stays where it's supposed to stay and reduces leakage. You see all of these, water main breaks. It's because the infrastructure is so old. So there are companies that help fix that, and I think that the new administration is going to focus on infrastructure. So we'll see opportunities there. Dividends. I mean, we always want to be looking for sustainable dividend, but growth, right? We don't want dividends that are just stable. We want increasing dividends, dividend growth, and we've got portfolios that are focused on dividend growth. So that's where we currently stand. I certainly appreciate the opportunity to sit with you today and to chat a little bit about the markets and the current environment we're in. Folks, this is an unusual environment, one that requires careful thought and professional management. Feel free to reach out to us at Align Wealth, where we can speak with you about your portfolio, about your risk tolerance, and then do a deep dive on your financial plan to make sure you are in the right place for 5, 10, 20 years in the future, to make sure that when you're on that road, you don't get knocked off in a turn here or there, to keep you on that road to retirement or to education for the children or legacies that you're building for the future. Thanks very much. Have a great night.